Hello all and welcome to this new episode of Your Next Trade, episode number 8 called Zero DTE Options. So why Zero DTE Option? Zero DTE means zero day to expiry. And these days the market is very much driven by short-dated options. If you remember correctly, in 2020 when we had the meme stocks, the GME, of this world, many market participants were using options, weekly options mostly, or 10 days options expiry to squeeze their longs. These days what we have is most short-dated options, which will be zero-dated, so literally that will be expiring on the day. Base will be expiring on the weekly option. So what we are facing now is huge swings from mornings to afternoon, and that has been the case over the last month or so, where the S&P is trading between 3,600, 3,800, same with the Nasdaq in terms of daily moves, and every single day you're going to have big swings between the lows and the highs because it's very much driven by those short-dated options. So those zero DTE options now represent roughly 50% plus of all the options traded on the US market. And if you look at a day like yesterday, that really makes the market much more volatile, and more long-dated options and or indicators like the VIX not as relevant as before. So if we look at the week-to-date asset performances, on the left-hand side, which is the stock market, you can see that the stocks, S&P, Nasdaq were up 5% on the week. So literally a risk on week. So we started the week very weak. Actually, the futures started at the lows of the week, and since then we were hovering between 3,650, 3,700. Then we had the OPEX yesterday, which coincides with OPEX means the option expiry. Meaning the options are expired yesterday, and just before the open we had a trigger that I'm going to explain later, which moved the market from 3650, 3750, 3770 on the S&P. So that explained a lot about why the market has been so strong. Very often what you have when you have extreme positioning 10 days ago, many market participants bought a lot of put options for downside, and when the market starts to drift higher, then they need everyone needs to follow up the gamma, the delta, everything that is options will be following, and that's literally what has been happening yesterday again. In terms of this confirmation of risk on, as you can see as well, is the dollar was weak on the week. Not that much, I mean 1%, but still. Market is really much looking at rates and how those rates will be impacting the dollar, how they will be impacting stocks. And this week, dollar weakening a bit at the end of the week by 1%, not much. Bitcoin, crypto flat on the week, gold the same, WTI flattish. Well, actually, if you look at WTI, flat on the week, but quite a move between the lows and the highs. So there is volatility. It's a bit misleading, this flattish WTI. And here I didn't put the scale, but natural gas, both in the US and in Europe, which matters a lot, were down 20%. So that is for the week-to-date asset performances. For the industry's performances, what you can see is obviously what was strong before any single week where the market was down. Dollar was strong on the opposite of the spectrum, the 20-year treasury as well, and if you look at overall the winners versus the losers, if you take the S&P around here, you can see that this is a 50-50 between losers and the winners, with oil services being very strong actually on the week, despite WTI not that strong. So XLE versus the SPY outperformed quite a lot still. Metals and mining, so a lot of economies using commodities again have been pretty strong. Cloud, so in terms of sectors and dispersion, there has been quite a dispersion between the winners and the losers, where the S&P at 5%, you can see here we are talking 9-10%. So actually dispersion into the equity market, which could be explained to a certain extent by the start of the earnings season, where very often with companies coming out with their numbers, they will be driven their own industries or their own sectors. In terms of rates, here I'm looking at the 10 years on the top hand side. We closed yesterday at 4.22% on the US 10 years. We made a highs of roughly 4.33%. So we had quite of a reversal yesterday during the session, which was 1 hour before the open or 30 minutes before the open. There was this funny article from the Wall Street Journal. So as you know, I don't know, starting from today, the Fed is in blackout period because we have the FOMC meeting in 10 days time, meaning that the Fed is not allowed, the Fed speakers, you won't see any Fed speakers, the Fed is not allowed to come into the market and see what they think about the market. And in the meantime, they potentially probably talk to the Wall Street Journal journalist and saying, we see 75 bips rate hike in 10 days and maybe 50-50. So what is important is we had a bit of a steepening of the yield curve, meaning the 10 versus the 2 steepened a bit, as you can see here. So when you say steepening, it's going higher. Don't see that already as the economy getting better. I think it's mostly technical so far. We had a bit of moves already that explained this technicality. That doesn't mean that the US economy will be firing on all cylinders very soon. What we have on the same idea with the US 10 years, the 2 years, is looking at the euro dollar. The euro dollar, the terminal rate, which is still in March. So the market has been pricing the top of the hiking from the Fed around March, and that's not been changed. What we have these days is, instead of having top of the Fed hiking around 4.75%, it's more into the 5% and above. So at the start of midweek, we had above 5%. We are back now around the 5%. Not much change on week on week. But as you can see before on the slide that I mentioned just before, we had a 20 bips move. So we went from 4% on the 10 years at the start of the week to 4.22 at the end. So quite a big change. And in the meantime, that goes against the week-to-date asset performances of the equity market, the stock market, that were pretty strong. So if you remember correctly, we used to have a huge correlation between bonds and stocks, where bonds, when bonds were selling, meaning yields going higher, stocks were following. And for the first time this week, actually, bonds have been the yields have been going higher, means bonds selling off, but stocks have been doing okay, and actually more than okay, as they have been up. For the VIX, for the volatility, again, I think the VIX is misleading, and maybe I should get rid of this tab forever. It's again mostly driven by the zero DTE option, this options expiring on the day, option expiring on the week. So you should be looking at, every time you get a position, every time you're looking at a stock, you're looking at a company, look at the option, if there are options, on the Monday, on the Wednesday, on the Friday, and every day you should be looking at the SPY and the S&P where it could be trading, because very much looking at the open interest will tell you a lot where the market could be driven. Looking at the OPEX yesterday, there was a lot of positioning into around the 3,700, then it was 3,750, and literally we drift higher. So positioning, we have a window of 10 days before the FOMC. So let's jump now into the technical analysis, starting with the S&P futures. And I'm using here a daily, and I will be moving into the weekly chart. For the first time, actually, for quite a long time, we had a decent week. So we started from the lows and closed almost at the highs. So that's technically that's a strong candle. As I said before, I was monitoring the 3580, 3600 for more potential downside, because I want to believe that 3400 are on the cards and 2900. For the time being, it's not the case. It's not a necessity to fight against the trend. So for the time being, this is what we have. This is the same picture for the Nasdaq future, a strong candle which could lead into more gains in the next few days, or at least for the next 10 days. The Russell is not as strong. I think it's a question of exposure to the US economy. The DAX, looking at the leading indicator for Europe, the DAX will be soon potentially challenging this trend, and that I think for your next trade that could be a potential good short. Looking at emerging market, why emerging market? Because as I mentioned last week during the last episode, China is having his Politburo. The whole week they're gonna re-elect their leader tomorrow evening, and we should expect the Chinese GDP on Monday. What has been very clear is China has been, and to say the least, very secretive about their data. The GDP that was expecting this week didn't come out, so there are some question mark of if the numbers, how bad the numbers could be, and obviously EM is one of the ETF that could be suffering from it, and that's the same with the FXI versus the SPY. So here I'm using a pair trade, being long the FXI and short the SPY. As you can see, this is not the good trade. Literally, China big caps have been underperforming the overall market. That was very interesting because I think it was on Wednesday, the market was pretty strong in the US, and Alibaba was very, very weak, trading around 75. So far, China and FXI and Baba and all the big names are underperforming the market. Let's see for this week if it's going to turn, but so far no change in turn. In terms of where we are and what is your next trade, it is obviously the earnings season. So earnings season means looking at the names that are coming with their earnings. We're going to have Microsoft after the close on Tuesday. We're going to have Amazon. We're going to have Apple coming. So if we're looking at Microsoft using a weekly chart, this is the trend what we have. So this is in a downtrend, and as long as it's not breaking this 275, we are in the downtrend. If you look at Amazon, interestingly, the big support is around the 102. Which has been resistance before. We have been testing it recently, and in terms of breaking this trend, we are potentially looking at 120 as a level. So very, very close of breaking on the upside for Amazon. Finally, looking at the currencies, the euro-dollar trade is still the same. It's in the downtrend. We are close to the upper end of the channel, so that is something to monitor, especially after the Japanese intervention yesterday, and more importantly, we have the ECB this Thursday, where the ECB is expected to be hiking rates by 75 bips, but more importantly, to give the outlook for 2023 and what they're going to do with the balance sheet. So, and the LTRO as well, which is how the banks could finance or refinance and having access to credit, to cheap credit through the ECB. So that's overall the picture for the currencies, where the renminbi is above 720. So there is not a big change. Drivers are still the same. For the CL1, we are in the downtrend. There is, as I said, a lot of volatility between the highs and the lows, which is very much what you should have with the CL1 for WTI. It's one of the most volatile assets. That has been a bit downplayed by the crazy volatility that we had in FX, that we had in bonds this year, but normally it's quite normal to have a 5-10% move, a weekly move on the WTI. It's just that these days the other assets are moving more than usual. So let's go back into Excel and looking at this week, just to go through what happened. So it's a bit of back trading, and it's always easy to be making money when we are back trading, and that is what you're going to see for any guy on Twitter. So what about China? China, we don't have the numbers. We don't know the numbers. So China, the macro is quarantined, very unknown. Hopefully, we're gonna have more numbers coming into this new week and having a bit more, not necessarily visibility, but at least data. For the S&P, so this is the range that we had. So every 2 sessions, we're gonna have literally 2 to 3% moves. So that makes the market quite volatile, to say the least, and that tells you about extreme positioning first, and how many market participants, and we are not talking only retail traders. So in 2020, it was all about the meme stocks and those, so-called retail traders that were only playing those GME, AMC on steroid with some weekly options. Whereas these days, it's more as well professional using it. When you have 50-60% of the volumes that are done with 0DT options or weekly options, that tells you about how important that becomes, and that makes the moves even bigger. Another clear development of this week is yesterday, so that will be here literally 45 minutes before the open in the US, so just before the expiry for the S&P or for the options and for the whole session. Guess what? Wall Street Journal comes out and say, the Fed is probably not pivoting, but we are getting close to the end of the hiking cycle, which is true. If it's March is only in 5 to 6 months' time. If the terminal rate is at 5% and your 10 years is at 4.25, 4.30, you are getting closer. So the market rallied on that. Again, that was helped as well with the positioning and the OPEX. So in your calendar, the first thing that you should be putting at any single month is when is the option expiry. So that's on the 3rd Friday of every single month. So this is why we had this 100 points move plus on the S&P, which equals to 3%. So 3% very quickly. If you remember correctly, last week we had as well a crazy move from the lows to the highs on the CPI, because again, that is very much explained by extreme positioning and by those short-dated options. What about the Bank of Japan? So Bank of Japan intervened very much 1 hour after this Wall Street Journal interview or article, where the Bank of Japan, the first intervention, so we are going in intervention number 2. The first one was around the 145. The second one was around the 151, 152. And yesterday they were extremely aggressive, so big volume. And literally hitting the bid as much as possible. As long as you don't have the differential between the US 10 years, which is at 4.20, and the Japanese 10 year, which is at 0 or 0.2%, there is not much change for the Japanese yen. So I guess the Bank of Japan, yesterday we get the release of the CPI around 3%, which was not great, but not disaster. But that explains as well the weakening of the Japanese yen. Intraday, you had a bit of help with the US 10 years going from intraday from 4.33 to 4.20. So that helps the risk on. Earnings move. Why is it important? So we are in the middle of the earnings season, and so far, if you look at the earnings, if you look here in orange about the sales, the surprises, and in blue the earnings, you can see that this season surprises from sales have been not great, so way below average, and the earnings have been okay. But you need to keep in mind that, and something that I mentioned a couple of weeks ago, that the expectations were lowered on a very high scale historically. So we lowered earnings expectation by 7% over the last 3 months, which is a big number, but sales are still pretty bad. So in other words, what you're gonna see, and I mentioned that before, if you look at Pepsi, if you look at L'Oreal, if you look at anything that is discretionary, you're going to have year-on-year sales that look okay, but it's mostly pricing. Okay, if you look at volume, they are down, and actually the surprises from the sales are not good. My view is still the same. In the long run, if you don't sell, if you don't have sales growth, your EPS are going to be struggling to grow, and that's what the companies are facing. Finally, for those of you who have been trading Europe, what has been key this week is we have seen a lot of short squeezes on names that are heavily shorted with high short interest. So I'm taking a few names, two in France, one is Orpea and another one is Atos, one in Sweden, Sinch, where those names, one's 37% up, another one 51, 16%. So what happens here is if you've been short for quite a long time, you've been making good money, literally, and some of those stocks are down 60, 70, 80% from the highs, and you are getting closer to the earnings season. What you do is you reduce exposure. You reduce your net and your gross exposure, and you take some of your winners and you say, okay, it has been done 80%. I think I've done most of the move. It maybe can go lower, but I had a good winner. So people will be reducing their short exposure, and due to the size of the short interest, you have a squeeze. So it's very much like what we had on the GME and AMC 2 years ago. These days, it's the same in Europe. The heavily shorted names will be squeezed. That doesn't mean that the underlying is better, but they were potentially way too short. So going into next week, starting on Monday, we're going to have, hopefully, the Chinese GDP. For the overall picture, as a leading indicator, the flash PMIs, Europe and the US, they're going to give us a bit more color of how the economies have been doing. Going forward, it's mostly about, central banks. How are central banks be pivoting? We will be starting on Wednesday with the Bank of Canada, then the ECB and the Bank of Japan. So that is the order for the FOMC meeting, which will be on Wednesday in 10 days. So it's hard for central banks to be a leading indicator of the Fed because everyone is following the Fed. But at least looking at the Bank of Canada, the Bank of the ECB and the BOJ, they could tell us under which pressure they are and if there is too much pain, and in a sense sending some signals to the Fed. So even if the Fed says, I only care about America, they do care to a certain extent if the dollar is too strong and if there is too much pressure in the piping, in the plumbing of the overall system. Interestingly and important, the PCE on Friday. Why is it important? Because this is the number one number that the Fed is looking at for inflation, and that's going to be obviously very important 5 days before the FOMC meeting. On the earnings side, we have 47% of the S&P companies that will be coming next week with their earnings. So we're going to have some big names. Here we don't have all the names, but I put some of the names. So we're going to have Google after the close on Tuesday. We're going to have Microsoft. We got Ford on Wednesday. Why I'm saying those different names? Because I want to be looking from one sector to another and see how the different leaders or the different big drivers are seeing their industries doing, keeping in mind that Ford, for instance, obviously already came with their numbers, so they pre-announced the numbers. Big day on Thursday with Amazon and Apple after the close, so we're gonna have big days on after Tuesday, so that means Wednesday session could be interesting and Friday session as well, with the PCE, with the Bank of Japan, and as well what you have on Friday is the last day of the month, so we could see some rebalancing of the overall exposure, as so far bonds have been selling off, looking at the 10 years, and stocks have been pretty much okay or small up. So rebalancing will be important. We don't have any Fed speakers, so don't expect to be glued on Twitter or on your screen for someone to be giving you some direction. In the next 10 days, they are not supposed to talk. So coming back on the earnings, I think what is important is the market is very much struggling to find new leaders. We used to have 2 years ago, the software companies, we used to have the semiconductors, we used to have the crap companies, then we turned. And for the time being, even the big names like Microsoft, Apple, Amazon have been struggling versus the S&P. And the market is in search of new leaders. Yes, you get an obvious leader, which has been Exxon, meaning XLE, oil, and oil services, which have been very strong. But keep in mind that they are leaders, but very small, so they only represent like 5% of the S&P. So for the S&P to get strong, you really need the overall big weightings, or some of the big weightings, to be strong. So I'm a bit I'm a bit concerned when people say, oh yeah, Exxon, XLE. Yes, but it's only a pocket of the market. So it makes sense for them to outperform looking at the overall picture, but it is not what is the market is really driven of these days. Finally, I put two charts, one of the S&P, the 10 years future, the 10 years not futures. The trend has been lower and lower, meaning the yields have been higher and higher. As long as we have this picture, the risk on is risk off has been the same. What has been interesting over this week, as I mentioned, there has been a bit of divergence, not that much, but a bit of a divergence between bonds and stocks. So we need to see if this strong correlation that started really, really big from the start of August over the last 3 months will be coming to an end. So far, what we had this week, again, is the bonds yields have been higher and stocks have been doing very well. So the last 3 months, pair trade has not been working for this week. So that is the catalyst. That is the biggest catalyst going forward. I think if you've been running this positioning for 3 months, and again, what you have in 10 days, you get a big event. What you do is you reduce exposure. So when you have squeeze on short day, on very short exposure stocks in Europe, that is the same. When you have divergence on a weekly basis versus on a quarterly basis between this positioning, is you get very much a catalyst coming, and people are reducing exposure. They are reducing their gross and their net exposure, and they are reducing where they have been winning. Why? Because you might expect a change in tone of the Fed. It might happen or happen, in terms of pivoting or so-called pivoting, but actually positioning will be reduced. So this is it for today. So if you get question on the 4x4 as usual, or the mentoring, you send me an email. You could be joining for free the trading community on Discord. So we are getting bigger and bigger. And I hope it helps people. And this is it for me for this week. And I might see you next week, or if it's not next week, that will be in 2 weeks' time. All the best. Thank you. Bye-bye.